We want to go to London, where we find BNP Paribas senior investment strategist Daniel Morris. He's joining us now to talk about how markets are reacting to all kinds of issues. And it's been an incredible week. I mean, we could have just had a whole discussion about China and the United States with China's moves on Hong Kong. But we have to talk about COVID, and we have to talk about these U.S. job numbers. Where do you want to begin, Daniel?
Well, I think the challenge is trying to assess what we see in terms of the reaction of the market, how much optimism really has been priced in there. I mean, for example, if you look at the Citigroup economic surprise indices, for the US, it's at all-time highs, right? So I think the kind of the very good news that we've had over the last several weeks, really since the last job report of the previous month, is the economic data is coming in better than expected. You know, the most dire forecasts in terms of the economic impact, haven't been realized. And so we're all quite happy about that. And you see that positive surprise reflected in equity markets. And so the concern at this point, when you kind of think of where to put that marginal investment in risk assets, is where's the best risk reward trade-off. And, with this kind of move in equities, and we all understand how kind of no one really expected it, no one's in a sense kind of happy about it, because we anticipate much worse news to come. We just don't think equities are particularly attractive right now. So in our multi-asset portfolios, we actually prefer credit, where you have the advantage of central bank support, and at the same time, what you still have are very good yields. Whereas if equities take a downturn because we're anticipating an increase in deaths in the US following the increase in infections, or we get some other economic data that isn't quite up to expectations, there's clearly that downside risk there that we don't see to the same degree in credit.
And basically what I hear you saying is something you've already said to us, which is you don't anticipate a major downturn as we go forward. I actually heard someone earlier say, look, we're out of the quote recession, that we're back into a new growth period. Would you agree with that? And would that be an impact for investors? I didn't say it. It was someone else.
Yeah, well, it's always nice to have a positive outlook on life. I think, where we've been surprised is, we talk about the shape of the recovery. And kind of this leg of the recovery, has been a bigger and sharper bounce than I think most economists anticipated. But it really does come down to what comes next, right? We're all concerned about, as was just discussed, parts of the economy that aren't going to come back as quickly as hoped. Anything around tourism, anything around restaurants. And the longer, of course, this goes on, we've already seen an increase in bankruptcies and defaults, and that's going to continue. So there's still plenty of negative forces and factors that are out there that are going to drag on the economy. And to anticipate that you're going to be able to see a continued recovery at this pace over the next 6 months, really does seem beyond optimistic. So that's where our concern is. Yes, it's been a nice bounce off of the bottom, but we do think the next leg is going to be much more shallow in terms of the recovery. And then ultimately, that's where we think it's going to be reflected in equities. You're not going to see continued appreciation from here. We've already made up all the losses. On the margin, what's going to really get markets excited from here? And we think that kind of surprise is going to be much harder to generate.
Daniel, are there any new ideas that you have been percolating on during this time? Because I think so often we hear tech, healthcare, and then we hear the beleaguered consumer discretionary, of course, the restaurants, hospitality, leisure, as you mentioned. Yeah. Are those kind of latter buckets actually good opportunities here? Because ultimately, the intention is, people will still fly, people will resume business travel. What's kind of your scenario here?
Well, certainly it's the right question. I think in terms of the sectors that have clearly benefited up to now, you mentioned tech, you mentioned healthcare, everyone certainly gets the long-term drivers in terms of earnings growth potential because of what's happened. That's quite straightforward. But at the same time, we're all very much aware of the valuations. And for example, we have a relative value trade underweight on technology versus the rest of the S&P. Just for that reason, tech has gone so far. It's hard to see the upside there. So I think it's not the growth, it's evaluations that concern us, particularly in technology, on certain parts of the market, not necessarily overall. And then conversely, if we look at the beaten down sectors, anything around tourism, around travel, around leisure, that's where you can at the same time find parts of the market, certainly find companies where valuations have become quite depressed You appreciate if you invest in these sectors that return may not be in a month or 3 months or even longer. But if you really are thinking about a longer term investment, it really seems to be more trying to find those opportunities among value stocks as opposed to at this point really chasing after the growth beneficiaries we've seen up to now.
And Daniel, of course, being based in London, you have a great dual perspective of what's happening in Europe as well as here in the US. How are you talking to your colleagues there and observing what's happening here in terms of not really being able to get a handle of the virus and seeing almost the first wave continue ad infinity and beyond?
Yeah, it is. It's always a challenge at times to explain America to Europeans, and this is actually a quite good example. There was certainly a sense here that the U.S. was just simply being too aggressive, and at times it seemed like perhaps a bit of envy because you didn't see the economic contraction in the U.S. the way you've had in Europe. But now we're understanding why that happened. There was just much more reticence in Europe to loosen the restrictions. In the first place, the restrictions were much more severe, but what that achieved was to get infection rates to a much lower rate before coming out of the lockdowns. And so at this point, so far, fingers crossed, most countries seem to be managing that without the spike in infections like we've seen in the US. So it does seem to be, from here, the perspective that the US was simply a bit too eager if cities and states had left the lockdowns in place for a while longer. We wouldn't necessarily be where we are today when now there's so much concern about having to go back in to some degree into a lockdown situation.
Daniel Morris is BNP Paribas Senior Investment Strategist. Good to see you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.